Good afternoon and welcome to Chicago Future of Finance. I'm Oliver Rennick. It's day 2 here. Thanks to everyone who tuned in yesterday. We're live on X, we're live on LinkedIn again, and we're live on YouTube today. As we continue to take this show to new formats, I wanted to come back to the top for those joining for the first time to talk about what we're doing here, what this show is about, and where it's going to be. It's Tuesday, Wednesday, Thursday. It's 2 to 3 p.m. into the closing bell every day, for a very specific reason, because this is about trade management, trading, watching the market into the close with an options-heavy bias. Brent Kochuba will be with me every day as we go through the gamma trades, the stocks that are moving the most, and that's about half of the goal for the show. The other half of Chicago Future of Finance is talking about how the Midwest is becoming a giant money center in ways that a lot of people have not yet come to appreciate. A lot of that conversation is going to center around advisors, registered investment advisor growth. And of course, part of that conversation includes the assets and the management and the products that those advisors need. Today, we're going to lean into that conversation with some really great guests. And I want to also remind folks that this is a format that is malleable, that we're experimenting with a little bit, and we are going to be taking it on the move. The Hood Summit Conference in Vegas, the second week of September. I talked today with the team there about the panel I'm hosting, and that's going to be awesome. That is all about the trader and the everyday trade, and that intersects with Chicago as well, of course, because this is the home of the trader. Now, the other big thing is that we've got risk management in Munich for SIBO's conference as well the week after. That's in the third week of September. So we're going to continue to try and blend that line where the retail becomes the institution. This is really a great place to report on that story, because in Chicago, the institution refers to the big advisors where the money is flowing into. Today, we're going to get into that conversation with Jack Ablin at Cresset Capital, who's joining us. We're going to be talking about management and product with Abbas of Harris Oakmark, a giant firm as well, on the other side of the equation, trying to fit these pieces together and help you understand where they're going and what are the major trends is a big part of this too. Yesterday, I talked about some of the numbers in Chicago, and I thought I'd run through them as well again, because not only is this about options and the amount of trading happening here, it's also about the assets under management that are piling up in Chicago. By the way, the third thing about this show is education. That's a big part of what's going on here as well, too. It's about making sure you know how to trade, but then trying to preserve it as well. One of the best educators in Chicago I know will be rejoining me for a continued conversation we've had, and that's Scott Nations joining us on the show as well. So we got a really good one coming up here, and this list is going to remain packed throughout the run of this program. Brent Kochuba kicks off the show with us. I'm ready to start talking markets if we bring in Brent and check out what's going on today. Yesterday was kind of interesting because we did get a little bit of weakness in some of the juicier trades, but the story, I think, today is a little bit about the core tech stuff getting hit. The fact that we were down yesterday in some of the juicy stuff, and then today we see the NASDAQ getting dinged, semiconductors getting hit pretty hard as well. That, I think, is kind of the story. Brent, can you hear me, sir?
Yeah, I'm all set. Can you hear me?
Beautiful. I hear you too.
Good.
Tell me what you're looking at. And while you do that, I'm going to get into spot gamma and start looking at some of the main levels here. But it seems to me one thing that stands out a little bit, Brent, is the VIX is kind of waking up today, not in a huge way, but yesterday VIX was really quiet despite some of those isolated trades like Robinhood and MicroStrategy and others like Open2 getting hit.
Yeah, yesterday, obviously, VIX expiration. So yesterday was the last day that August VIX contracts could trade. They expired at 9:30 today. So as a base case, that loosens up volatility a little bit, right? Because a lot of the positions that reinforce the lower volatility environment we've had, they left. And then similarly today, the other fascinating thing that happened was we saw a bunch of 0 DTE SPX contracts coming in trade right around that 63.40 area. And if Oliver, you remember yesterday, there was a big position at 6,400, 0 DTE. Market went right down, tagged that level, and stuck there. Well, what happened today? Market goes all the way down to 63.40 in the S&P, tags that level. Those puts get closed, and the market rallies all the way back. So there's a lot of intraday volatility and intraday swings. But what's happening now is that volatility is not following through, right? We're getting mean reversion, and that's kind of keeping a lid on things at the moment. So to your point, VIX broke out a little bit this morning. When you look at fixed strike volatility, that's how volatility is changing on a strike by strike basis in the S&P. It's actually pretty quiet right now. And so there's a lot of churn. There's a lot of anticipation about the Fed on Friday and NVIDIA next week. But so far, this volatility is remaining contained, and it seems more about simply adjusting short-term adjustments as opposed to like kind of a full panic, which could ensue if Powell upsets things and NVIDIA earnings aren't very good.
A lot of stock-specific stuff, it seems like, is the way we can describe some of this, Brent, which is equity-specific weakness. The chart here, to looking at spot gamma, the dip below 63.50 today on S&P. I mean, that was a pretty decent little tumble because we tried to start off a little firm. Yeah. How do you kind of gauge the appetite for upside versus what it seems to be a stronger appetite for downside? I get your point that VIX hasn't really moved too much. Vol's been generally contained. The market too still is trying to bounce off these key levels. But is there a bias that's developing a little bit more negatively on the intraday?
There is. I mean, if you go into this week, we had extremely low implied vols. So we had S&P short-term vols around 10%, which is about as low as you ever get. Second thing is we had the Fed was priced at 95% rate cut. Everything seemed peachy keen after CPI and PPI. And then the other one was the AI narrative has been untouched, right? It's just this incredible force that's going to drive the economy forward. And then suddenly, as you touched on before, the FOMC rate cuts have slid a little bit, right? Now there's a little bit of trepidation or nervousness around, what the path is with rates. And then the second one with what happened with NVIDIA, or excuse me, Meta yesterday was, look, we may be cutting back some of our AI spending. And then suddenly the tech darlings started to fold a little bit, right? And then that sort of released some of the air out of the bigger bubbles in the market as well. Palantir obviously getting crushed, MicroStrategy getting crushed, crypto kind of losing some of this. So I think what you got is everything was priced for perfection, and that narrative of perfection was so dominant into last week. And now people are a little bit nervous about what the Fed may say, that for guidance. NVIDIA, if you look at the change in skew for NVIDIA earnings, there's a real pickup to downside implied vols. It's not massive, but there's definitely now some concern about what NVIDIA may say. Maybe NVIDIA guides a little bit lower, just says, hey, our earnings are still great, but we are a little bit worried, as opposed to just crushing every single quarter, right? So,
by the way, it's not for lack of action, Brent. I'm looking at your options volume right now. I mean, 3 million on NVIDIA still. So people are in there, and it doesn't seem like they're losing too much confidence, I guess, despite the last 2 days.
Yeah, excuse me on that too, because Palantir at 2.4 million contracts is a massive amount of volume. I mean, absolutely massive amount of volume. And so, there's a lot of kind of like momentum trading, I think, in these names. People making short-term bets, swinging stuff around a lot, but we're not seeing people, if you looked at our Flow Patrol report this morning, you're not seeing people put a stake in the ground, right? We didn't see huge, longer dated positions come in Palantir when the stock dropped a lot yesterday. I'm talking about buy side positions. We're not seeing people trying to establish, stick their necks out, in other words, into these data points over the next couple of days. And so you're going to sum it all up again. It's like, look, we were priced for absolute perfection until last week. Now people are hedging some of these events in the short term. We could easily get a benign Powell, right, and NVIDIA sales that are in line. And I think we're right back at 6,500 by the end of September.
Brent, I'm going to look back in the S&Ps. I think the stock-specific commentary, very relevant, very true. A lot of it seems like it does hinge on NVIDIA. But I'm pulling up your GEX levels here on the intraday so we can take a closer look. If you're an index trader, if you're thinking about it on the S&P level, at what point do you start to get a little bit nervous? And maybe by the flip side is what would be impressive ground if we could reclaim it?
Our risk off number this morning was 6,400. That's the level that we were looking at. And we talked so much about zero DT options, right? And Oliver, if you scroll on the bottom chart there, you can grab that teal circle at 3 o'clock. You can wind that back to 9:30.
Okay.
You just drag that to your left, and we replay the market, right? You can see down around 63.40, there's no positions. There's nothing on your bar chart there, right? See that?
Right, nothing over here.
Right, so tick forward just a little bit, go to about 10 o'clock, and you're going to see huge positions right there, right?
You see people start getting ahead of it, basically trying to play that 63.50 level as soon as we soften up.
and you see a huge position established at that level, and the 0DT contracts just pound the market lower. We're talking about put buyers and call sellers. It's pure 0DTE. We call this the seek and destroy algo, right? Because the market knows where those big 0DT contracts come in, and we fill down to those levels. So you can play that chart forward now, and you see the market just go down there. It tags that level, and all of a sudden that flow just totally shifts, right? The construction goes away. And what's interesting, and the reason I bring this up is because at those lows of the day, what we saw was longer dated SPX put sellers come in. So people are saying, look, this was a big move down, maybe a little bit too extended. Yeah, if Powell upsets the apple cart here, fine. Maybe we'll have to bet on some downside. But for the moment here, the market seems to have established that this 6,300 level is maybe a little bit too cheap. Now, if Ford guidance changes things, then we'll adjust. But in terms of vol and in terms of the way that people reacted to the lows, it seemed like there were some dip buyers of the non.
Pretty quick to buy the dip down there. To your point, by the way, this is a fun tool to go and watch what happened throughout the day via the options positioning. They come in, they buy the dip there. Once you get to that big gamma wall down at 63, 50, 40, high 40s, and this is a nice pop here. The question, I guess, Brent, is one, and we only got a minute here. This is kind of an impossible one to answer, which is how do you know when to bail after these kind of gamma bounces if you're trying to scalp intraday? But the other thing I would say, if folks have not gotten out of the buy the dip trade yet this afternoon, it's a decent intraday chart when you can see kind of these higher highs creeping in. That hit there at 2 p.m. right before we came on air wasn't great because it put in that intraday lower low, but it still is a decent daily chart here. Especially it seems like if we could touch 6,400 by the end of the day.
Yeah, and it's going to be look, it's up to Powell to sort of like lose the narrative, right? I think people want the market to go higher, they're positioned for the market to go higher, and you got to force them out of these trades, right? You got to force them to run ahead. And the deal here is that, look, when risk flares, if Powell says, hey, we may not cut or we're going to reduce the number of cuts you should expect, those 0DT people, they fade, right? They're not there. And so you got to keep watching this 6,400 level. I think we probably recapture it today into tomorrow. But through Powell, like if we lose that 6,400 level, that's where I think risk really starts to percolate. And that's where I think you could see the VIX shift to 20 pretty rapidly.
Love that. Well said. Nice look. Love the intraday chart. That's a really cool tool to follow it and see how we traded throughout the day. Brent, great stuff. Great look at the intraday there. Nice look at the levels. Little bit of action here, as you can hear behind me, right as we're pushing basically to that 6,400. Let's get straight into my first guest live here at Seedbow, Mr. Scott Nations, the president of Nations Indexes. How does it feel to be down here, Scott?
It's good to be down here. It's been a while since I've been on a physical trading floor. It's been
in terms of how it kind of, do you feel the market when you hear people, you know, like that? We got that kind of pop there, and it's literally right as we're pushing to kind of the highs of the multi-hour chart.
The interesting thing in my time on a floor was you could hear what the market was doing. That is, as volume increased, literally the volume on the floor would increase.
And Scott Nation's volume too.
And I did pretty well when it comes to presence in the pit. So that was actually something really interesting that you could take advantage of. As you move off the floor, you have to learn to look at very, very different cues. And so it's good to be back. Yeah, you can hear when the market is really kind of doing something special.
Do you think, and by the way, this is fun because we're kind of doing something special as well.
Yep.
We're a bit of a Seedbow competitor in some products, but in the spirit of doing a program in a place where people are making markets, I thought this would be a fun conversation because some of what you're doing at Nations Indexes is trying to find other ways to assess volatility, basically.
We're trying to deconstruct skew because if the only thing you look at is VIX, and let's face it, the VIX is the 800-pound gorilla. It's the volatility index everybody knows about.
They're right over there.
And but if all you're looking at is VIX, then you don't know what's happening in, say, out of the money calls or out of the money puts or deep out of the money puts. It's all kind of mushed together into a single number. And so we deconstruct skew with our Voldex measure, which is purely at the money implied vol. Our Calldex measure, normalized price of one standard deviation out of the money calls. Put dex, important on a day like today, normalized price of one standard deviation out of the money puts, and then tail dex, which measures the likelihood of a crash based on what people are doing in the option business.
Now, here's what I guess if I were to kind of take a contrarian view on the need and the utility for kind of breaking apart a popular product. It's almost like a technical perspective where people say, oh, well, if everybody's looking at that, then it does matter. So if this thing's so big, if the gorilla's so heavy and people are using it, then does it keep its force in the market?
Oh, sure, absolutely. But that doesn't mean that smart traders can't know more than what VIX is telling them. And the way to do that is to deconstruct skew. I put it this way. If the only thing you look at is VIX, which again amalgamates just essentially every out-of-the-money option that's listed, and that's the only thing that you look at, that's a little bit like looking at the S&P 500 and seeing what it's doing on the day, but not being able to look through it and see what any of the individual names are doing. What's NVIDIA, what's Tesla doing. If all you can see is the headline S&P number, you don't know what those numbers are doing, and you're really at a disadvantage.
You talk about how you used to feel the pit and feel the noise and feel the market. Obviously, what you're building here is very, very data-centric. You have a partnership with Spider Rock, which is a Chicago-based entity as well. But I'm wondering, are these usable products and concepts for just kind of the everyday person? Where is that entry point where you're doing such size or you're trading markets in such a way that you really need to take that kind of under the hood look at vol and break it up?
Well, we don't actually think it's that much under the hood, because we focus on a few important elements or swaths of the option skew. But the important thing, and something we talk about in our Volatility Insights newsletter, weekly, free, everybody should sign up.
Nations Indexes.
Nationsindexes.com, and you can sign up for it there. Is what we say is that you pay attention, for example, when these indexes get to extremes. And on the website, we explain what the average is and what the extreme levels are. And for example, we had a great trade last month in AMD because Caldex was really high, very high, 76th percentile of its 52-week range, and the stock was overbought. So when calls are very high, and the stock is very high, that's a great time to sell a covered call. So we had a great covered call that people learned about from our indexes.
So much of this market right now seems to be about vol up, price up, vol up and price of underlying up. Whether it's the way people are scraping income off of very volatile products that are generally still going higher, if it's what you're talking about here on stock specifics, is that kind of the story of volatility and options today? Is that a beast that we're going to have to, that maybe we like right now? We're seeing these opportunities. Can it work against us?
I think one of the really interesting things is that about 10 years ago, we started to see systematic vol selling strategies, particularly in ETFs, whether they're selling covered calls or they're doing the JEPI product. They have driven implied volatility, that is the cost of options, down to a very fair level. And I think the next thing we're going to see is people taking advantage of that by systematically taking long positions, long volatility positions in options. And so I think that's actually going to be the next step. But, for example, something that we talk about on our X account, for example, is you can get a tremendous amount of information if you look at what out-of-the-money puts are doing versus out-of-the-money calls. So our put dex measure versus our call dex measure. And you would think that if volatility was up, those would both be up. Everything would be up. Those diverge, and it has nothing to do with market direction. It's purely a measure of implied volatility.
Those diverge. Exploitable opportunities.
That's right.
Vol.
Those diverge on about 44% of all trading days.
Wow,
and that is exactly
a pretty high divergence.
And we were really surprised when we did that analysis and saw that number. And that is something people can take advantage of.
Okay, before we let you go, because education's a big theme here, do we have our OJ in the AI graphic here? Because you're an author. I want to run by some AI stuff for you. Let's play it. Character looks like David Gura from Bloomberg, who everybody used to say looks like me.
That's fantastic. That's hot. That's really great production value.
So this is the theme of the block here, and we've got a Q&A. I want to make sure we hit at least one with Scott here before we bring in John or Pete today, actually. Let's do, that's it right there, the one about crashes, actually. Scott, you've got a great book. I think you've got two great books recently, Anxious Investor, History of the Five Crashes. And that one I'm still kind of like, I still like that one to reference a lot. So I asked the AI, if you take into account the five major stock market panics, what are a few of the main conclusions? It says, Each look different on the surface, but 3 constants show up. Leverage builds quietly, liquidity vanishes suddenly, and confidence breaks faster than models assume. Those are the triggers that matter more than the headlines. Fragility hides in plumbing, not price. The ICTV AI is pretty interesting. What do you make of that response?
That's really interesting. One thing I would say that I would add is, yes, leverage builds quietly, but it builds often in novel financial contraptions that we think are going to solve a problem. And the classic example is portfolio insurance in 1987. I mean, what could make you feel better than portfolio insurance?
Right.
But what it really was, it was leverage building up. People invested more in equities than they should. And when it came time for everybody to get out with portfolio insurance, the door is just not big enough for everybody to get out at the same time.
Anything right now that looks anything like any of that stuff that worries you? It's option stuff
the Fed
ETFs, or
option prices are low because it's August, so I wouldn't read too much into that. I would say that the Fed does more damage by keeping rates too low too long, like it did in 1929 and like it did in 2007, than it does by keeping rates too high. So be careful what you wish for if you're wanting the Fed to cut rates. The other thing I will say is I mentioned the contraptions. Everyone is fueled by a contraption. We're looking for what the contraption for the next one might be.
Okay.
I'm not saying there's going to be a crash around the corner. Crashes are rare, thank God.
Yep.
But you do start to kind of wonder what the next contraption might be. You wonder if it might be private credit.
There's a lot going on in private.
There's a lot going on in private credit.
Into our advisor conversation later on. Great to have you here, Scott. Fun hit.
Great to be here.
Making a market for ideas.
Great to be here,
in a place that's Seaboat and Scott Nations.
And congratulations.
Thank you, sir.
Thanks.
Appreciate it very much. Scott Nations, president of Nations Indexes. We've got Pete on today for the gamble. I say we just run that gamble intro and talk about Kalshi and markets. Mr. Pete Najarian, how you doing, sir?
I am doing great, man. I tell you what, it was the hardest thing to get into this whole window of this platform, but I'm in.
I love it, man. I appreciate you guys. We're having a pretty fun time kind of figuring out how to build a mobile but still like heavy content, hard-hitting thing. I would love people in my history of TV to check out the rig that we're running this from right now, because it's not a room, it's not a control room, it's a mobile station.
That's who you
but
are.
You know how
man.
it is down here. You got to carve out your spot.
You do. You got to. I remember the days, man. That's why I wore those crazy coats and all the other stuff, and you had this goatee here and everything. I got to stick with it because it's been good luck for a long time.
That's right. In fact, hey, today I thought it'd be fun. We talked to John yesterday. Tell me if you guys differ. I mean, in so many ways, you guys are so similar. But I know you guys are different. I've hung out with you guys. What about your trading and your styles? Where do you guys have different approaches with certain assets, styles, preferences?
I might have been a little bit, standing on the trading floor specifically, probably a little more aggressive maybe than John. And that was just because I'd played football for a long time, came to the trading floor, and, you still got that blood boiling inside of you, man. So, I brought a little bit of that with me, and it made me a little bit more aggressive, and I traded pretty large. And John trades big. I just might have traded a little bit bigger. So, that's where we're a little bit different. But you know what? The risk, I always covered myself in certain ways that I could, the best I could. But, you're always going to have some risk somewhere. You can't eliminate all of it. So, I had some positions that sometimes were a little bit nerve-wracking for people.
Any that stand out? Were there any that made you nervous? Anything from back in the day, either here or, even if it was off the floor?
Well, I'll tell you what, it was primarily on the floor. And I would say this, when I stood in the AOL pit, when that was a big stock, that was kind of a Netflix back in the day as far as the volume and people talking about it and all this crazy stuff. And there was a point in time where they actually called the office and said, hey, Pete's one of the larger shareholders of stock in this company.
Yeah,
but for me, It was hedged around though, right? I mean, I had calls and I had puts and I had all the things, but they just wanted to confirm the number of shares and that type of thing. So, you never know
It's a
what's going
good
to happen.
problem to have. That's like at the poker table when they come over and they say, "Hey, we need to get you some bigger chips. We got to clear out your space in front of you a little bit. We're gonna give you the green chips."
That's right. That's right.
Tell me, what do you see any of that type of stuff, Pete, in your kind of instinct when you see some of these big bubblicious moves over the last, call it since the low, basically, since the tariff low of the spring? I don't need to go through and name all the names. I think a lot of them are really good companies, but some of these moves have been explosive. And I think the last 2 days, do you get nervous that anybody's carrying too much size?
Oh yeah, I think there are some stocks out there that have been able to be on the ride, and this ride from those lows in April all the way to where we are right now. And I think there are some that are probably overpriced. John and I, we're always looking for the unusual option activity, right? I mean, you're sitting right there at the CBOE. We're looking for that option paper that's size, the option paper, whether it's in a huge entity like the VIX itself and some of the trades that go along with that, or obviously just the individual names. And there's what I like about our market, what I've liked about our market, I should say, since April was we had leadership from tech, but it wasn't just tech. We had leadership from financials. It wasn't just financials. There's always a new leader, it seems like, for a week or two along the way. And that, for me, tells me it's been fairly healthy. It doesn't mean that every one of those deserves to be going as high as it's gone. And I think there are a lot of examples out there of stocks that have ripped to the upside that probably have no business being there. And they'll correct at some point in time. Now that it's just a matter of when, right?
Do you think the last 2 days presents any clear buy the dip for any of those high flyers, Pete? Is it you still think in trend to be buying on these dips? They're kind of trying to in the S&P today.
Yeah, and you know what? It's been fairly successful. I mean, the markets were looking really awful just an hour or so ago, and now all of a sudden we're starting to see them start to improve. Obviously, not as much on the Nasdaq, but certainly on the Dow and the S&P. So, I think these markets, there is so many different factors that are affecting the markets right now that it makes it, that much more difficult. But that's what we do, right? That's what we do for a living. We're trading options and we're moving in and out. And I never have thought of myself as a day trader. But that being said, I will tell you, if you get the move that day, I think you have to react. And, those moves that take sometimes a day, they used to take weeks, maybe months to make those kind of moves. You buy something for $1 that all of a sudden is trading $4. I think you have to make, the disciplined decisions along the way. And I think that, that's one of the things that's helped out myself. It's helped out John, a lot of the people that are part of Market Rebellion, because we post up all the time what we're doing and how we're doing it and all the rest of it. And that's, I think it's been a benefit for people.
Let's get a little risky, Pete. Let's go through some event contracts for 90 seconds. I got Kalshi up, and I thought I'd start easy just looking at the Bitcoin at 125 and get your thoughts on that. It's kind of an interesting approach, trading an asset versus betting on a specific price level. To some extent, it kind of seems like some of these events recreate the use of an options contract to some extent. But how do you think people should think about this when you're got the option to, all right, I can either trade the underlying or make this kind of binary bet on if Bitcoin's going to hit 125?
Yeah, and I think for some people that's probably the right approach. I think for other people, myself, that's not really the way I want to approach it. But they come in with an opinion, and they want to be able to trade off of what the opinion is. They come in thinking, you know what, Bitcoin was 125,000, it's dropped down to XYZ. I think this thing's going to actually bounce back and get to this level at some point. So, and everybody's got their opinions on these types of things. These trades become very interesting trades. I still have a little bit more of a conservative side on this particular kind of trading because it's difficult, right? I mean, you're looking at something and it's either yes or it's no. And
right. Okay, it kind of makes it like blackjackifies it a little bit, It kind of makes it this binary thing in a way.
Right, absolutely. And you know what? That's great for the people who understand it, and they understand what those risks really are. That's fine. But as long as they understand that risk, my biggest thing in life is just that people need to know who they are. And
sure.
So, I know that sounds ridiculous,
but
it's true. You have to know, do you like that much risk on? Because this is a binary bet, and that's a lot of risk, right?
Yeah, true. Pete, great stuff. Thank you, sir. Looking forward to more.
Really appreciate it, man. Take care.
Absolutely. Najarian, co-founder, Market Rebellion. Going to take a quick break. Be right back. Jack Ablin, Cresset Capital, joining us next. Welcome back to Chicago Future of Finance. I'm Oliver Rennick. Let's talk RIAs, let's talk growth and how Chicago has become a massive money center thanks to growth like companies, including Cresset Capital, which now has post-merger hundreds of billions of dollars under management following a deal with Monticello. Jack Ablin, former CIO and now chief investment strategist and co-founder and a longtime source of mine on the market, joins us today to talk some big picture. Jack, it's a great pleasure to have you here.
Thanks, Oliver. Yeah.
Did I get everything right there? Start me off with that.
Yeah. So really, it's sort of an extension of what we're doing. We've been doing a lot of obviously private market due diligence, asset allocation, portfolio construction, and mostly focused on family offices and ultra high net worth. So by extending into the nonprofit space, both family office though, and endowments and foundation, it's really a natural extension of the work that we're already doing.
Jack, I think the first we started speaking was about the time I came here, which was 2017. Correct me if I'm wrong on the math, but Cresset, even prior to this deal, had grown to upwards of $70 billion from, I think, maybe 10 or so when I met you.
When we met in 2017, that would have been, we were at zero.
Wow. So maybe 2018.
We put the firm together in Q4 2017. By middle of 2018, we probably had about $3.5 billion.
Okay.
And as of right before the close of this deal, we were at about 76 billion before the close of this deal.
Now, Jack, how much of that, what I'm trying to figure out and what I'm trying to catch people up to speed on, because I feel a lot of people are they're kind of oblivious to the fact that Chicago now ranks by many definitions #1 in the advisor space. Barron's ranking of the mega RIAs says this is the only major city with 2 of the top 10, Cresset and Hightower. Obviously, there's different definitions of how assets get tallied up, but the only other city is Overland Park, Kansas. And I think that we get the major city qualification. Is that a regional thing, or is it because of innovative products or the model that these companies have built here?
Yeah, I mean, I think it's really a perspective. If you think about New York as really more of a sell side city, so that's where, the big brokers brokerages are, the investment banks, that sort of thing. And that Boston, I would argue, is really more of a, call it institutional buy side, whether it's mutual fund. I mean, I started my career in Boston working for a mutual fund company, and that's still an asset management hub. Chicago, and you can go back to Stein Row, you can go back to the Mesereaus of the world, has really been an advisor-centric city, and I think that's probably why we're seeing a lot of this concentration of advisory business and high net worth in the Windy City.
What do you do once you get that big? Obviously, part of this deal with Monticello is finding a partner that's as big too. But when you start to get to these monster numbers, how does an RIA retain the flexibility and the specificity to give their clients an edge, to make sure they're delivering what I've heard described from the street as the Yale model, is what someone described Cresset's offering to me as?
Yeah. So if you think about it, I mean, bottom line, we're public market beta, private market alpha. So clearly managing risk and managing allocations in the public market is, we can do that, with the size we have with pretty much impunity. And I don't think we're going to be moving markets in, the $1 trillion market that the public markets represent. On the private side, I think that our diligence and our size will matter. If now we're the size of a sovereign wealth fund, what that means is one is write big checks. So we can get behind, a lot of key sponsors, and then also expect fee concessions, perhaps GP economics, and all of that gets passed to our clients.
International, Jack, is that part of this? How big of a role is that? How well does the U.S. advisor model translate overseas?
Right now, we're 99.9% U.S., and so our clients are dollar-based, and that is pretty much where we seek our comfort. I think on the private side, I do think we will, allocate a little bit more internationally. We've really pretty much concentrated our private market allocation domestically. I think we are going to start to expand overseas there. Whether or not we take on, foreign family office or other high net worth business or even institutions remains to be seen.
Okay. Jack, one of the things that I've always loved talking to you about, or one of the reasons why, is because for someone who sits on a pretty big seat, you always stayed and as it grew, that seat got bigger, you always stayed very in touch with markets. I'm curious now, in your role as chief investment strategist, thinking about the new private side as well to this, how has your own understanding of the markets had to shift, and how should people's understanding of the market shift if they're going to be more engaged into private assets?
Yeah, so I think the key to the private markets is going to be access. It's also going to be illiquidity. I think that's really the important part of it. And you have to be willing to accept illiquidity. And in exchange for that, you should demand a higher risk premium for that. So when you start getting into these mega models that offer you some sort of quasi liquidity, whether it's an interval fund that lets you out every quarter, you end up diluting the impact of what you're trying to achieve. And it may be great if you need the liquidity, but then you won't get the illiquidity premium that typically comes along with investing for the long term.
Jack, to kind of put it together, one thing that I've been thinking about, and I'm not sure if this is the way to think about it, but as I see portfolios start to get built in with more private assets, and then I also see stories and we see a lot of private equity involvement from an investment side of the advisors, how do we make sure all that stuff remains separate? Is there any concern about having private assets in a fund that then are associated with the private equity backer for a company? How do you make sure to make sure all that fits?
Yeah, it's funny. I would say, as our company's evolved, we've certainly grappled with those issues early on, and have moved to more of what I'll call an arm's length relationship with all of our sponsors, all of the funds that we deal with, generally preferring just third-party funds. And especially now that we've grown to the size that we have, this is we need to really reach out to a whole network, if you will, of the preeminent players. And the fact that now we have the size and we can write the checks, we're going to get our phone calls returned.
Jack, great stuff. I appreciate the insight. I appreciate you being here. A different, a fun conversation. I think it's a super informative one. I'm looking forward to more. Thank you.
Thank you, Oliver.
Absolutely. Jack Ablin, Chief Investment Strategist, co-founder at Cresset. We'll be right back. We're going to bring in a Chicago bond whiz who manages more than $4 billion for Harris Oakmark. We'll be right back. Welcome back to Chicago Future of Finance. I'm Oliver Rinnick. We just heard from the buy side from RIA giant Jack Ablin at Cresset Capital. Now we've got what I dare call the sell side. Abbas joining us from Harris Associates, Harris Oakmark previously. You manage two funds. One's over $4 billion, and you're a Chicago native. It's great to have you here, Adam.
I came over to Chicago at 18 years old, went to Northwestern University, and I've been here ever since. Got to go to University of Chicago for my MBA. Worked for great institutions like Lehman Brothers Asset Management, New River Berman, right down the road, 190 South.
Love that. That was a Easter egg slip in there.
That's right.
You got any gear left over from that? I
do. I didn't put on eBay. Went over to Richard Driehaus's outfit, got to help with the fixed income efforts there. And then most recently found myself at Harris Oakmark, where we're really pushing into fixed income dedicated space. And we just launched the Oakmark Bond Fund 5 years ago. It's going really well.
That's OakCX.
OakCX.
I referenced OakBX, which is the Equity and Income Fund. Before that, what was the business like in terms of the education at Northwestern versus Chicago? Did it feel like you entered a different ballpark at University of Chicago, or was Northwestern a beast too?
It's a great question. I mean, it was a beast, but for different reasons. I was actually an engineering undergrad, so I learned a lot of the technicals around critical analysis.
What kind of engineering?
Industrial engineering.
Okay, all right. I didn't see that when I did the research.
So the groundwork was there. We were doing a lot of the math, the critical thinking, but really the extension into the finance world and learning a lot of the details around understanding accounting and the nuance around how to think about financial evaluations. I really learned at getting my University of Chicago degree, so it's been great.
Still the top of the class in your mind, University of Chicago comparatively?
No doubt,
right?
No doubt. I'm biased, but no doubt. Northwestern undergrad, U of C, MBA, best there is.
All right. Well, let's talk some efficient market in the fund. Let's start with equity and income first, because I feel like there's a lot that we talk about that's increasingly blending that line. equity products that are generating income, if it's ETFs using options to pull in heaps of income off these high flying companies, or when you look at bonds, how do you blend that? Where do you find the happy middle ground?
Well, I think the 60-40 space was kind of left for dead after 2022. We saw loss of principal on a mark-to-market basis with fixed income. People weren't used to seeing a 10, 15% drawdown on the 40% portion. And a lot of people have given up. They've rotated into gold, alternatives, et cetera. We think it's a really great time to be in the 60-40 space. That 40% fixed income, high quality balance sheets, high visible free cash flow, you can produce about 5.5% yields without taking a lot of credit risk. We want to think about corporate balance sheets. We want to be with management teams that are really taking a prudent approach to balance sheet management and in capital allocation. But I think that 60-40 in this new era where you can collect 5.5%, and that fixed income portion can be a ballast once again, I think it's a really good place to be, and don't give up on it.
A lot of the hate on the 60-40, essentially.
Yep.
I asked something similar to Sean Dranfield at PTAM yesterday, and his response was kind of, look, I just want to have an interest rate agnostic bond product.
Duration neutral.
Yep. Duration neutral. Is that a way through it, or is there, because it seems like your approach is security selection.
It is.
And I think that's what's interesting in your background too, because I've heard you on podcasts. I mean, you know the ins and outs of a lot of specific companies, almost the way that I hear traders talk about it from an equity side.
Yeah, no doubt. Harris Oakmark, that's really the core of the DNA, is we want to spend our time producing attribution for our clients through understanding the balance sheets, the cash flow statements, income statements, the management teams. We want to understand how capital allocation looks, what type of return on investment they're getting, and how that translates to ultimate intrinsic value, and then how that translates to ultimate default risk. And at the end of the day, we want to provide our attribution through that credit selection and not through making, we live in a tweet by tweet world.
Right.
We live in this.
People like that though. These guys like that.
They like it, and it can be good, it can be bad. Like transparency all the time, everywhere, we think is kind of to our advantage when we take a step back. We're disciplined 3 to 5, 7 year horizon. And we look when the market's all pushing one way, maybe it's a momentum factor, maybe it's a tweet, maybe it's an intraday move. We're looking back and say, what does this ultimately mean for fundamentals?
You're in there on short term, buying credit,
it's all a fundamental approach. We want to think about intrinsic value, our long-term horizon, and what that mean for expected return.
Will it skew towards a value profile if you're doing it the bottoms up way?
It absolutely does.
Okay.
And on the stock side, we do about a 30% discount to intrinsic value. On the bond side, it's a spread approach, so about 30% to spread. So if you have 100 over credit, we're trying to look for something that trades at 130 and trying to get that spread compression.
Okay.
So it's always value discipline. We think that degree of safety actually is a kind of a risk mitigant that's provided to our clients.
Right now, the breakdown of bonds versus stocks in your fund, I think I saw it was at least 2/3 stocks.
Yeah,
is that right?
It's 60-40. We actually like fixed income here at its peak. We were right around 68%, 32% for stocks versus fixed income.
Okay.
I think recently fixed income has become more compelling as valuations have risen on the stock side. And all-in yield has stayed elevated above 5%. I think real yields, you can get 2.5%, depending on your view of inflation.
Right.
I think that's really attractive. Just high quality compounding at 2.5% makes a lot of sense to us here.
Who do you find wants it the most? Who's in the, because it seems like there's almost kind of an in-between where like you want the income, you want to have, you don't want to take equity-specific risk to that extent, but you also don't want to be creeping along if everything's going to be up in a way as it has been. Is there an opportunity cost to being deeper into stocks if you're playing in fixed income?
Well, again, where our approach is long-term horizon and just really value oriented. So really it comes down to price for us.
Okay.
We think the prices afforded to us in fixed income are relatively cheap here.
Okay.
And as we look over 3 to 5 years, again, if we can compound at 2.5% real returns, that's a pretty attractive proposition, especially with where multiples in some of these growthier, more momentum trades in the equity side are trading today. So we think it's a pretty good trade-off, and it's a good spot to be.
Anything that you think in particular, security-wise, sector-wise, how specific? You got something hot for us?
Well, we don't do hot, but I think in general,
Where do you think it's undervalued? Where do you think it's
not
a
staying
deal?
away from the benchmark where all the flows are going to in the fixed income space, the big benchmark names. We like moving in kind of the more esoteric space and securitized credit.
Okay.
Looking at places that just a little bit less traffic where all the flow isn't going to. I think there's still opportunity if you look hard enough in those spaces to pick up some spread, pick up some yield, and total return opportunity.
Tell me about securitized credit. Do you like private stuff? Is that working into that direction?
We're staying mostly public in what we do, but we still pick up on a relative basis, we're still in the 80th, 90th percentile we can pick up versus public corporate credit spreads. We think that's pretty attractive, especially in the higher quality portions of those stacks.
I think a lot of the stuff we talked about there for bonds applies to Oak C, right?
It absolutely does. Yep.
Beautiful. Adam, great to meet you. Thanks for being here.
Great meeting you.
Great conversation. A very good addition to us here. We hit buy side, we hit sell side. We talked some bonds. Adam Abbas joining us from Harris Associates, head at fixed income. We'll be right back. Mr. Scott Bauer and a risk radar for you. Be right back. Stock market's pretty close to the highs of the session here as we wrap up at 10 minutes into the bell. I'm looking at equities grinding back after a little bit of a dip. Let's go to the risk radar, which now keep in mind as intermediate values. There's yellow, there's red, there's green, and then there's dark yellow, yellowish green, then there's very positive green. So the stuff around the edges of the risk radar is basically, in my mind, the most solid looking stuff. And I still put stocks in that category. You see the bull icon down there with the solid green label. That's because we've broken a little bit. We've bent, really. We haven't broken. So I think equities are in okay shape until we really start getting further downside, or you see some of these stock blowups turn into sector blowups. I think that's an NVIDIA story next week. A few of the individual names that were really saucy to the upside, like MicroStrategy, Open, and Hood, have taken a little bit of a kick in the teeth the last 2 days. And I don't like to see NVIDIA and the semis getting hit with tech. But I'm holding it green. Gold is on the next level of green, partly because I'm still trying to figure out if gold wants to break out. I don't have super strong feelings about it, but what I do know is that gold generally looks solid in the long-term trend. Here I am. Bonds, right in the middle, yellow. We heard 2 takes on bonds in the last 2 days, and at this point, I still am unconvinced either way. It looks like a range-bound trade for me, and trying to figure out how Trump and Powell are going to interact seems like a disaster. The dollar's in the mix too. Let's bring in Scott Bauer, who's going to join me to give his thoughts and tell me where I missed, where my logic doesn't add up. If I sound smart, dumb, etc., I can trust him to give me the honest dope. Mr. Bauer, what's up? Scott, you got me? There he is.
No, that is for sure. You never, ever sound dumb. Can you hear me, Oliver?
I got you. Now I got you. Yeah.
Okay, good. Might be loud behind you there. No, you are spot on. And in terms of the equity markets here, yeah, the Nasdaq's taken a little bit of the brunt of the selling here, but you're right. This is still a marketplace until we see differently. This is still a marketplace that is fairly on track to move higher here. I'm not worried about a big sell-off whatsoever. And then in terms of gold, we've talked about this a lot over the last 6, 9, 12 months. Gold has been a buy the dip. You have to follow that trend. We're still in that trend, even though we got a nice rally today and GLD is up, $3 or so today. That is still a nice rally. There's more to go here. It doesn't mean that it's going to go up, just vertically, right? Or we're always on that stair step approach. It doesn't need to be a binary move, but it is absolutely still a buy the dip.
It's just gold. It seems hard to lose, Scott. It's like no matter what regime we get, it at least hangs on. It's like your downside seems like, part of me, I'll be honest, part of me feels like a lot of people, they could have a very simple approach to the market right now, which would basically be gold and like Bitcoin or something else high beta risk, because that juicy stuff, high beta, when it goes up is killing it. And then gold seems to go along for the ride and doesn't ever really go down that much. So like, I know that's kind of a crazy thought, but like the gold Bitcoin portfolio, do you hate it?
No, I really don't. And if people are looking for excess alpha, right? They really want immediate results. Okay, maybe crypto Bitcoin is the way to go, but you're going to see fluctuations in the marketplace a lot more than what we have seen in gold. And again, regardless of what we have seen over the last weeks, months, pretty much since Liberation Day, let's even call it here, gold has been probably the steadiest of any asset class out there. It has recovered on every pullback and every pullback pretty immediately. So again, until that trend changes, and I don't see any fundamental reason why it would, because the reason why people have been buying gold and central banks have been buying gold over the last 12 months or so, that hasn't changed. So fundamentally, the story for gold has not changed.
Yeah, I feel you. I'm on board with that. It also seems like it kind of relates to the bond thing being stuck. Let's go back into Trader Oasis here. I'm going to pull up NVIDIA. I feel like any conversation about the market, I think this ranks above Jackson Hole, Scott, but I don't know. That could be certainly a point of contention or debate.
It absolutely is. Jackson Hole, everybody is really on top of it. Can't wait for Friday. I'm included in that. But by Saturday, or at least by Monday next week, that's going to be behind us. And the market will kind of reset to whatever they believe the commentary was from Powell. It's just video. And we say this often during pretty much every earnings cycle. There is a group of Apple in the past or Alphabet, whatever it is, that boy, we got to watch that one to give us an indication. But with all of the news coming out that maybe the AI trade is overcooked, tech is on its heels a little bit now, there's probably not a time that I can remember that we're going to see an earnings report as important as what NVIDIA says. And it's going to be really about what they say about guidance moving forward.
Absolutely agree. It's, here's the thing though. I got to be honest, Scott. I mean, you saw the show yesterday. This could not be done without AI. Well, it could be done, but it wouldn't be as good. Graphics, sheets, getting this up off the ground in the time we did in a high traffic place like this requires you to use everything to your advantage. And so that's where I've kind of become radicalized a little bit here in the last couple months. I've been calling it the everyday trade. You trade things that that you use every day. I am using AI every day.
No, there's no doubt about that. And just to your point there, you're using it for your application. Just think of the other people, other businesses, major international corporations that are benefiting from the use of AI. And I still think that we are in the very, very beginning stages. And you know, the AI trade may be cooling off a little bit here, but again, and there we go. There's the closing bell.
There it is.
That's the ebb and flow of the marketplace. You know, it's a stair-step approach here. So, you know, are some of the extreme valuations that we've seen over the last several months, you know, some of those that have really gotten hit? That's probably a good thing in the market for that to reset as well. So NVIDIA really is a focal point here, and couldn't come at a more important time, Oliver, with this quarter's earnings winding down, with interest rates right around the corner, with tariffs again, you know, still front and center here, and obviously all the geopolitical risks that may be out there. So the market at this point really needs something to be very positive about. Again, I'm not saying that I'm expecting any sort of big drawdown, but the market needs that next accelerant. It needs that next, you know, kick in the behind to say, all right, you know, we're going to rally the year end.
Needs a pep in its step. But hey, we closed out okay here today. Definitely could have been a worse session. You know, I know that we kind of slipped a little into the, you know, final moment there, but still we hit 6,400 right before we dropped, you know, 10 points at the end. So we got back to the open price for the session, which is not bad.
You know, SPY to be down, you know, what, 0.25% when 2-3 hours ago we were looking at, oh man, maybe we're going to see another 100-point down day or so. And, you know, there's a reflection in the marketplace, and especially with the traders behind you and the traders in the VIX pit over there, there's a reflection that it's still kind of a Teflon market. And I say that because we're not seeing volatility really move. Sure, the VIX was up, you know, 16 handle today at some point, but that's really nothing. Now, that being said, and I think I pinged you about this earlier today, for the first time in a while, maybe some of the retail or institutional trades coming out of the woodwork, there was a lot of far out of the money call buying in the VIX today, out in November, not September, October, out in November. So, you know, is that just because vol and the vol of the VIX, the V-vol is so low and people are buying some time? It could be, but it's been a while since we've seen buyers coming in of 75 and 100 strike call options in the VIX.
Wow, way out there.
Yep.
Yeah. Good eyes. We will see you tomorrow, Mr. Bauer. Thank you, sir.
Thank you.
Great closing wrap there, the session. Stocks, nice little grind pretty much throughout the last hour there. Thanks for joining Chicago Future of Finance on YouTube, X, LinkedIn. Kind of feels like it disappears there, though. I'll see you tomorrow. We got another great show with some great people coming up. I'll see you at 2 p.m. Central Time right here at CBO.